Right there, everybody. Welcome along to this Wednesday afternoon market recap. I hope you are doing well, no matter where you are located around the world. It has been a tremendously volatile start to this week, largely expected, based off the waterfall sell-off that we witnessed in the second half of February. Volatility, again, remains rather elevated as we move into the beginning of March. In fact, if you take a look at the technical picture, at least analyze that of the daily candlesticks taking place since that intra-session reversal on Friday as of last week, you can see collectively again that the market's pushed on up roughly 4% on Monday. The majority of those gains were given back during Tuesday's session, on average down roughly 2.8%. Today, however, again, we've seen the markets push back on up. We're now pushing above and closing above that of Monday's relief rally high. And also we're pushing up into this upper wick, which was established very early on in yesterday's session, being Tuesday. In this Wednesday afternoon market recap, I'm going to continue off from the thoughts that I left you with on Monday. And also, it's really just a string of thoughts that's a continuation off from some of these patterns that we are continuing to witness, set up, and play out as we look and break down the US financial market indices. Before I move into the technical picture, I just wanted to say I'm hoping to make this as clear and precise as possible, as straightforward as possible, just so you understand where we are in terms of this clearing rally, in terms of this relief rally, which again is maybe only halfway through. Okay. Yes, we have this red rectangular box on my screen. This is a Fibonacci retracement based off the entire sort of sentence of that first waterfall sell-off. But again, the glaringly obvious thing that I'm going to point out to you is, again, the magnet, which is going to continue to pull equity prices up, right? We can see, of course, some net negative days, which could be rather tumultuous like we saw on Tuesday. But overall, and over the coming weeks, we can expect this market to, again, climb the wall of worry, to push back on up into what is still a very technically broken chart, not only on the S&P 500, but more so on the peripheral vision. As well, when you take a look at the industrial average, the NASDAQ, and also extending that a little bit further into the Russell 2000 and the Dow Jones Transportational Average, I want you to understand that right now people are sort of breathing a sigh of relief. They're witnessing this market climb, but it's going to exhaust itself. All right, don't think for a moment that this is it, that we're shaping up some form of a V-bottom recovery and that the worst is behind us. Again, this plays into the different fractals of the marketplace and understanding the significance of this up here, more recently in the midsection of February, being that intermediate swing high in the market. What we've done essentially over here, if I go out and show you this on the weekly chart of the markets, if I can bring this up, is that we have now entered into the intermediate correction of the markets, in all of these markets for that matter as well. And you need to understand, according to Dow theory, that the markets themselves, they are working, or at least always moving in conjunction with differing fractals. If you can understand that this is the intermediate swing high peak, and this is the direction of the intermediate correction back into the primary bullish macro trend, well then you will understand very simply, if I can color coordinate this, that this relief rally that we've witnessed really Friday through to today's close on Wednesday, this is what we call the M for the minor level. And really what this is doing again is bringing people unfortunately into a temporary sort of false sense of security, whereby again, they're just hoping and again praying that this market is going to move up, which again, in all likelihood, it is going to continue. But the reality is that this is still going to fail up and around these higher prices. At this particular point, based on the fact that this is an intermediate correction, if you look again on the weekly oscillators, just to show you, we really haven't moved all that far out of overbought territory on the stochastics. Yes, we've corrected on the RSI, but the MACD, pardon me, is only just getting moving really into negative territory. This is telling me that this has still got a number of weeks, if not a number of months, to actually play out until we move back into oversold territory on the MACD, which is going to establish that real intermediate low. So again, continuing off from the thoughts that I left you with on Monday, I want you to understand that all of the technical charts out there, really, and when I say all, I'm talking to probably more than 90% of anything that's really chartable out there or broadly looked at through the guise of charts itself, are technically broken. What do I mean by that? Well, first of all, again, we've got this big, ominous open window. And again, this is sort of the honeypot whereby the market is drifting up towards, but at this particular juncture still, as at the close on Wednesday, I expect it is going to get absolutely clobbered up and around this resistance area. What does this mean for people who are following along with this analysis? I've had a lot of emails over the past number of days, and more specifically, even today, as at Wednesday, asking, well, do I close out of my net long positions if I have them? And the answer to that question is obviously I cannot give you specific investment advice, but really what I'm looking at, and all I can really do is share my charts and share my thoughts with you, is that again, if you're looking at this market drifting up higher, why would you sell out of any long positions that you have? And on the flip side, all right, a lot of people are emailing in saying, hey, this candlestick is now in the red box. Is it a time to go short? And the answer to that question is, well, again, if it's myself, one, I'm not trading short at the moment. And two, we don't have any early reversal candlesticks whatsoever to even sort of support that sort of outlook at this particular time. Again, we're looking for these candlesticks to show up roughly in the vicinity of this red box, if not at a higher price up and around the closure or the potential sort of trying to actually close this open window. This is where I assume the reversal candles are going to show up. What we will do is we will set up a series of structures, of lower structures like I spoke about over here, and the trapdoor. Remember that video that I put out in the midpoint of February, establishing the trapdoor, whereby you build the structure, and then once you begin to crack below it, the sort of the house of cards begins to fall down. That is going to be, right, a multi-week setup. It's not something that's going to play out overnight. Yes, we can see, of course, the markets continue to pull on back down in very aggressive movements. However, they should be bought, and overall, you should see the net momentum of the market on the minor level of the trend working in conjunction with the bigger intermediate level of the move, right? Push to these sort of general prices that I'm sort of describing or illustrating to you on my chart. It's coming in at roughly 3,300 on the S&P 500. Now, if you wanted to look at it like this, again, this is sort of moving into pro a little bit, but if you wanted to establish the actual range of the intermediate trend, in all reality, what's going to happen is that you've got the beginning of the range up here at, say, 3,375, and you've got the target of this down here at about 2,700. So we were delicately placed at about halfway of the move. We made that very clear in the weekend class. Now that we're pushing back on up into this rectangular box, this is giving people an opportunity, if we see the structures, right, begin to set up in the reversal setup, and also, of course, on the daily time frame whereby we see these oscillators push back up into short-term overbought conditions, but again, to establish a little bit of a lower high across the board, especially on the MACD, it's going to set the stage for one, for you to really clearly and very obviously get out or sort of sell to close any open long positions that you have, and even potentially begin to buy to open net negative positions, whether or not it's shorting stock or buying puts. That's essentially the lay of the land if you're looking at the US financial markets at this particular point. Now, again, generally what we pick up on are themes, all right? It's very important to pick up on themes in the actual indices themselves, but also when it comes to individual companies as well, because again, it's going to confirm what we're seeing in the overall market indices and what we expect is going to play out. Now, if we assume that these markets are pushing back on up into, at least into this area to close the open window, and we're suspicious that they're going to fail or fall up and around this general location, we want to essentially confirm that with other markets, or at least other individual stocks in our top 12 individual trade lists, and understand the theme of the technicals being broken. Again, have a look at this on Apple, for instance. You can see this red rectangular box, the magnet pulling Apple back on up to close its open window. We're still moving in the face of an intermediate correction on the weekly time frame of these markets, whereby, again, the Apple stock itself is only just correcting out of overbought territory, which again, and again, when you're bringing all of this together, you have to understand, right, the prevailing trend and how the fractals are coming together. It's very important for you to do this. You cannot simply just look at the markets on a daily time frame. You need to intertwine it at minimum with the weekly time frame also to really understand this. But again, we're getting this relief rally up into this daily open window, which again, we're looking at it completely being rejected at these higher prices. It's not going to be perfectly synchronized between, say, for instance, the NASDAQ and Apple, but you're going to see a theme prevail. Have a look at Amazon. Amazon is starting to bounce off from its trend line. It's moving back on up where to? It's moving back on up into its red rectangular box of resistance, right? This is where the shorts are going to begin placing trades up here. Once we get on up, we don't have to definitively close the open window. But again, it is a damn good sort of target to be looking at in terms of one, closing out long positions, and two, looking to short if we start to see the setup. All right, it's too early, it's too premature. There are no confirmation signals at this particular point, but I assume, all right, my intuition is telling me that this is what is going to happen. If you go down the list, all right, I'm just going to sort of stop when I see it. Baidu again, surprise, surprise, what do you see? red rectangular box, open window, the beginning of the waterfall sell-off. Hasn't really bounced whatsoever, not to the degree at which we're seeing in Apple and Amazon, but I think you can see the general sort of picture. Caterpillar, let me move down the list. A little open window up here, beginning of this sell-off. Green for support, target, right? So you can sort of see the past trades anyway, that generally I don't really go into when I map the individual trade setups. That's more for a weekend class. But again, I hope you can see this relief rally coming into a bunch of individual stocks. A lot of people are going to begin buying this, probably at the absolute worst time up here when they see the market already have moved such a distance or has already made back, say, 80% of the waterfall sell-off losses. And again, it's buying into the complete flush out of the market, taking out its structural support dating back to Friday as of last week, whereby we have seen this very short-term minor level reversal Monday through Wednesday, which is now setting the stage for that next big swing, that very big volatile swing in the markets moving forward. Disney, it hasn't really bounced at all, but you still have that very ominous red rectangular box, the gap resistance. Have a look at Google, bouncing off from technical support. Volume, by the way, is trickling out of the markets. Volume, by the way, is trickling out of these individual stocks as well, which is a telltale signal that this is not the bottom for the market, and this is only sort of that pausing move during the larger intermediate move to the downside. IBM, what's it trying to do? It's trying to establish a short-term bottom as it pushes back on up to close its open window. Microsoft, I think hopefully at this point you're seeing the theme. I hope you're seeing how this is all coming together. Netflix is held up relatively well compared to that of the other stocks that we are looking at in general. Now, again, the transportational average, very close to, technically speaking, that of a bear market. We still haven't really seen any degree of real conviction in the push off from this support. But when I extend this over into the Russell 2000, you can see this magnetic color line. This is a very important support and also resistance area. But again, this is very early on in the bounce back on up to set up that next lower high, which a lot of people are going to sort of fret about when that reversal sets up. Now, a couple of markets, I'm just going to point out the obvious again, as I've already spoken about. At this particular point, and probably contrary to sort of prevailing public sentiment or the prevailing discourse at this point, I still firmly believe that this is not, or at least we haven't established that of the market low. As of Friday last week, this is nothing more than a clearing rally, which is going to exhaust itself, and it's giving you, again, potential to either close out of a lot of sort of damaged positions if you're looking at this and coming from a position who isn't in pro, and if you've simply just held into this and sort of disobeyed a lot of the warning signals that we've spoken about, all right? You're being given an opportunity to do that. Otherwise, you can be on the forefront. And I just want to leave you with some closing remarks really about the structure of the market, but more so also the sentiment. I want you to sort of sit back and think about just how quickly the sentiment shifted, whereby the market seemed as though there wasn't a risk in the world. They were completely carefree, it seemed, and everyone assumed that this market was just going to continue on its merry ways. Think about the change in psychology. Think about the change in public sentiment. Think about the change in societal sentiment in general as well, and how it has been exacerbated by the fall in market prices. Generally, when you move into an intermediate correction, you get, of course, this relief bounce. A lot of people think the worst is over, but again, there generally comes a secondary sell wave, which takes out that swing low, which then again just forces people emotionally to sell those positions, and generally that's what we call a complete flush out of the market, whereby we move back into a prime opportunity whereby the market settles after, unfortunately, the disinformed, more passive investors panic, sell their positions, think the market is making a major turn for the worse. However, they don't really understand the application of the broader market structure. So again, this is a warning in and of itself as at the close on Wednesday that yes, things are looking good. And if you're on the long side of this market, it's fantastic because you're doing very, very well. But again, there's only going to be a limited time until, again, fear comes back into the market, a degree of panic comes back into the market, and a very quick reversal, which is going, or at least which should, if it follows the general patterns that I'm looking at, should take out Friday's swing low going back to last week. And again, I'm not here to sort of provoke any fear, but objectively speaking, That's generally the route the market takes. There are a number of examples to sort of mimic. Go back to 18, the fourth quarter. You get the first stabilization rally, you get a couple of bounces, the bottom gets taken out, boom, everyone panics, which sets in stage that next continuation of the fan line, the accelerating fan line off from the prevailing bullish macro trend. You see it play over and over again. If I go back and show you this as well, you have to go back to 15, 16, where again you see some temporary flush outs. Again, a bit of a larger rally taking place here. The structure is formed. What happens? The structure is taken out. In this particular instance, you don't go a lot further than we did over here. But again, it's just another opportunity to load up on long positions, whereby the majority of people, unfortunately, were probably buying during this stage over here. And again, they were trapped on the opposite direction of the trade. So again, when you see the market up, it's not a time to be putting risk on. It's time to be taking risk off, and vice versa. When you see the market in a state of capitulation, it's time to be putting risk on, whereby the majority of people are selling out of those positions and taking the risk off. So again, it's good to see the market up. It's following the general sort of forecast that we've been speaking about, which is great. But don't think for a moment that we're out of the woods. We're just moving through the hoops and setting up that next backdrop, the structure that is, upon which these markets are going to ultimately break. And then again, I think you know what happens next. This type of move is what happens next. All right, so I'm going to leave you with that as at Wednesday afternoon, everybody. Enjoy your evening. Enjoy what remains of the rest of your week. And I'll see you in that Saturday analysis class. Farewell.